Artificial intelligence looks like power. New models, new breakthroughs, new billion-dollar valuations. It looks autonomous. But the companies building AI don't actually control the money that sustains them. They don't own the data centers. They don't own the energy grids. And in many cases, they don't even control the capital structure keeping their expansion alive. AI appears to be software. In reality, it behaves like infrastructure finance, and infrastructure finance is never neutral. In 2026, the real question isn't who has the smartest model, it's who controls the capital beneath it. Because if the money moves, the power moves with it. Training frontier. AI systems now requires billions of dollars in compute infrastructure, massive upfront capital expenditure, long-term supply agreements, construction of hyperscale facilities, chip pre-orders secured years in advance. Very few AI companies can fund that alone. Instead, they rely on layers of financial backing, cloud partnerships, strategic investors, sovereign wealth funds, government subsidies, credit markets. Take the relationship between Microsoft and OpenAI. OpenAI builds the models. Microsoft provides the infrastructure and cloud distribution. But the financing structure underneath that partnership is complex, layered, and capital intensive. Control doesn't just come from code, it comes from who controls the capital stack. Across the world, governments have understood this. The United States passed the CHIPS Act to subsidize domestic semiconductor production. India is committing billions to build sovereign compute capacity. Saudi Arabia and the UAE are investing through sovereign wealth funds to secure long-term AI infrastructure positioning. These aren't tech investments, they're financial positioning strategies, because whoever finances the machines influences who can use them, and that creates leverage. There's another layer most people miss: debt. AI infrastructure is not funded purely through equity. Large facilities are financed like industrial projects, through bonds, through structured financing, through state-backed guarantees. If credit tightens, expansion slows. If capital markets become restrictive, frontier training capacity becomes constrained. This means AI scale is not just limited by engineering, it's limited by liquidity. When venture capital slows, as it has across parts of Europe, startup ecosystems shrink. When sovereign funds deploy strategically, as we're seeing in the Middle East, new AI hubs emerge. Money shapes geography. And then there's payment infrastructure. Most AI companies rely on cloud billing systems controlled by a handful of global providers. Revenue flows through payment rails dominated by US-based financial systems. Dollar clearing remains central to global digital commerce, which means financial sanctions, export controls, and capital restrictions can indirectly influence who gets access to AI capability. This is not theoretical. US export controls on advanced chips don't just restrict hardware. They reshape financial flows tied to those supply chains. When capital access becomes conditional, autonomy disappears. So what does it mean when AI doesn't control its own money? It means dependency. Dependency on capital markets, dependency on sovereign backing, dependency on infrastructure owners, dependency on geopolitical alignment. An AI company can design the smartest system in the world, but if it cannot secure compute financing, or maintain cloud partnerships, or access dollar-denominated payment systems, it cannot scale. Scale is rented, and rented scale comes with conditions. This is why we're seeing a shift towards sovereign AI. Countries are beginning to ask, if artificial intelligence becomes core infrastructure, should it depend on foreign capital? Should it depend on foreign cloud providers, on foreign payment systems, on foreign chip financing? The push for sovereign AI is not about nationalism alone. It's about financial autonomy, owning the balance sheet, owning the capital pipeline, owning the liquidity that sustains scale, because when money becomes strategic, dependency becomes risk. The illusion of the AI race is that it's about code. In reality, it's about layered control, physical infrastructure, financial backing, geopolitical leverage. Each layer determines who scales. Each layer determines who depends on whom. And as models become more expensive to train and compute becomes more concentrated, the financial layer becomes even more decisive. Not every AI company will survive, not because they lack intelligence, but because they lack access. Access to capital, access to credit, access to sovereign alignment. So when we ask who controls artificial intelligence, we shouldn't just look at engineers or founders. We should look at balance sheets, at sovereign wealth funds, at subsidy structures, at debt markets, at payment rails, because infrastructure anchors power, but finance decides who can build it. And if artificial intelligence doesn't control its own money, then someone else ultimately controls its scale. In the next episode, we move one layer deeper into that power struggle. If capital shapes AI, what happens when access to the most advanced chips becomes restricted? Because the next phase of this story isn't just financial, it's geopolitical, and it's already underway.